China's gold rush versus COMEX silver drain. What's fueling the market? China is not buying gold. It is burying dollars. While Western markets sleep, Shanghai is pricing silver $12 higher than New York. Every single trading day, institutional hands are pulling real metal off the COMEX floor. Not paper, not promises. Physical, gone. And the one number they are not showing you suggests this is not a market move. This is an exit strategy. The question is not whether this is happening. The question is, who gets left holding the paper when the physical runs out? Welcome to Financial Crisis Explained, where we do not chase headlines. We read the architecture behind them. Now, before we go further, if you have been watching this channel for a while, you already know what this information is worth. So do something your younger self would have done instantly. Hit that subscribe button. Think of it like this. You would not let your most trusted financial advisor walk out the door without getting his number first. Do not let this channel disappear from your feed either. One click, that is all it takes. And tell us, where in the world are you watching from right now? Drop your city, your country, right there in the comments. Because the people watching this video are not ordinary viewers. They never are. Now, let us get into what is really happening. Two numbers sitting on two different screens but on opposite sides of the planet are telling two completely different stories. And almost nobody in the mainstream financial world is talking about it. On Friday, silver closed at $84 in the West. Clean, orderly. The kind of number that makes financial anchors nod and move on to the next story. Nothing to see here. Markets functioning normally. Go back to sleep. But pull up Shanghai. Shanghai is pricing that exact same silver at $96. That is not a rounding error. That is not a time zone glitch. That is a 14.5% premium. Eastern physical metal commanding nearly 15 cents more on every single dollar than its Western paper counterpart. And for those who understand how global commodity markets are supposed to function, that number is not just unusual. It is a structural alarm. Here is what makes this even more precise. This is not a one-day anomaly that appeared and will disappear by Monday morning. Track the sequence over recent sessions, and the pattern becomes impossible to dismiss. 13.85%, then 13.8%, then 13.7%, then 14.5%, then 14%, and now 14.6%. That is a trend with direction. That is a signal with consistency. And in the language of serious market analysis, consistency in an anomaly does not mean the anomaly is becoming normal. It means the pressure underneath the surface is building. The market is not correcting this spread. It is widening it. Now layer in what is happening at the COMEX, the commodity exchange in New York, which for decades has functioned as the global pricing authority for precious metals. Professional buyers, institutional hands, entities that do not make emotional decisions and do not chase social media sentiment, these players have been walking into the COMEX every single trading day and pulling out physical silver. Not contracts, not positions on a screen, real metal, bars, taken off the floor and moved into private vaults, session after session, consistently, without pause. This is called taking delivery. And when institutional players take delivery at this frequency and this scale, it communicates one very specific message to anyone trained to read it. They do not trust the paper. They want the physical. And they want it now, not at some future settlement date. At the exact same moment this institutional extraction is happening, something equally important is occurring on the retail side, except in the opposite direction. The Sprott Physical Silver Trust, one of the most direct retail instruments for silver exposure in the Western market, is currently trading at a 5.7% discount. Western retail is not buying. The average investor, the person watching mainstream financial television, the audience being told that markets are stable and inflation is under control, they have not come back to silver at all. That contrast is everything. Institutions are pulling physical metal off the exchange with both hands. Retail is sitting on the sidelines at a discount. These two forces are not contradicting each other. They are confirming each other. The smart money and the crowd are diverging. And history has a very consistent record of showing who gets the timing right in that scenario. For context, go back to 2011, the last time silver made a move that the entire world eventually noticed. During that run, the Sprott Trust carried an average premium of 17.3% across the full year. Retail was euphoric. Sentiment was everywhere. The move was loud, visible, and ultimately fragile. Because when a rally is built on retail emotion and speculative froth, it collapses the moment sentiment shifts. Right now, the Sprott Trust sits at a 6% discount. This move, this quiet, systematic, data-confirmed accumulation, is not being driven by Western speculative sentiment. It has not been contaminated by the kind of excitement that burns fast and reverses hard. And that distinction matters enormously for what comes next. Because when Western retail does eventually return, when the price action becomes impossible to ignore on their screens, the premium shift alone will compound the return significantly beyond the physical price move itself, that spread. from discount to premium, is a return multiplier that most people will only understand after it has already happened. The divergence is not the story. The divergence is the warning. And in part 2, we decode exactly what China is building with all that gold and why the timing of it is not accidental. Forget everything the headlines told you about China buying gold. The headline said accumulation. The reality is something far more calculated than that. What China has been executing, quietly, systematically, across nearly a decade of deliberate positioning, is not a trade. It is not a hedge. It is not even an investment strategy in the conventional sense of that word. It is the construction of an entirely parallel monetary architecture. And gold is not the decoration on that structure. Gold is the foundation. Start with what is visible. The People's Bank of China, the PBOC, has been reporting gold reserve increases with a consistency that, on the surface, appears routine. Central banks buy gold. This is not new. This is not alarming. This is the kind of data point that gets 3 sentences in a financial brief and then disappears. But here is what the 3-sentence version never explains. Central banks do not report everything they hold. There is a category of gold accumulation that moves through sovereign wealth funds, through state-controlled intermediaries, through channels that are technically outside the formal reserve reporting structure. Independent analysts tracking gold flows, not press releases, but actual physical movement data, have consistently identified a gap between what Beijing reports and what the shipping manifests, refinery outputs, and import records suggest is actually moving into Chinese custody. The reported number is not the real number, and the real number is significantly larger. Now understand the geography of where this gold is coming from. It is not being purchased openly on the London bullion market in ways that would immediately register as a geopolitical signal. It is moving through Switzerland, the world's gold refining capital, where large bars are being recast into smaller denominations, more suitable for Chinese storage and distribution standards. It is moving through intermediary trading hubs. It is being acquired through relationships that do not appear in the kind of data that mainstream analysts typically review. This is not conspiracy. This is logistics. When a nation-state is repositioning its monetary foundation, it does not announce the blueprint. It executes quietly. And the execution here has been patient, precise, and entirely consistent with a strategy that operates on a 10-year horizon, not a quarterly earnings cycle. Here is where the strategy becomes impossible to separate from the broader geopolitical picture. Since 2014, following the freezing of Russian assets and the accelerating use of dollar-denominated sanctions as a geopolitical instrument, a very specific conversation began happening in the corridors of non-Western central banking. The conversation was simple. If dollar reserves can be frozen, they are not reserves. They are hostages. Gold cannot be frozen. Gold cannot be sanctioned. Gold does not require a correspondent bank, a SWIFT code, or the permission of the United States Treasury to function as a store of value between 2 sovereign parties. Gold is neutral. And in a world where the dollar has been weaponized as a tool of foreign policy, neutrality has become the single most valuable monetary property on the planet. China understood this before most nations were willing to say it out loud. Now look at the timeline with precision. The PBOC's publicly reported gold reserves have grown from approximately 1,054 tons in 2015 to over 200 tons as of recent disclosures. That is the official figure. Apply the analyst estimated gap between reported and actual holdings, and the real number, by most serious independent assessments, sits considerably higher. Simultaneously, China has been building yuan-denominated gold trading infrastructure. The Shanghai Gold Exchange, operating as a direct competitor to London and New York pricing mechanisms. The Belt and Road Initiative has quietly embedded gold settlement frameworks into bilateral trade agreements across Central Asia, the Middle East, and Africa. This is not a collection of unrelated policy decisions. This is a sequenced strategy moving toward a single destination, a world where the yuan, backed by the credibility of physical gold reserves, can function as a legitimate settlement currency for global trade without requiring dollar intermediation. And here is the part that most Western analysts are still refusing to price in. China is not trying to replace the dollar overnight. Overnight replacements are violent, unstable, and invite retaliation. What China is building is a parallel lane, fully functional, fully gold-backed, ready to absorb the traffic the moment the main highway develops a crack it cannot repair. The gold is not the signal that the strategy is beginning. The gold is the signal that the strategy is nearly complete. And when you place China's gold architecture next to what is happening at the COMEX, the picture that forms is not a market story. It is a countdown. In part 3, we go inside the COMEX pressure point itself and examine exactly what happens when the paper promises run out of physical metal to back them. There's a mechanism at the center of Western precious metals pricing that almost nobody outside of institutional finance fully understands. And that mechanism is cracking, not loudly, not in a way that triggers breaking news alerts or causes financial anchors to interrupt their scheduled programming. The crack is quiet, technical, and buried inside data that requires genuine effort to interpret. But for those who know exactly where to look, the fracture lines are unmistakable. Begin with the fundamental architecture of the COMEX itself. The commodity exchange in New York does not function like a farmer's market where physical goods change hands in proportion to the transactions taking place. It functions on a leverage model, one where paper contracts representing future delivery obligations exist in quantities that dwarf the actual physical metal sitting in registered vaults. For most of its operational history, this model worked because the overwhelming majority of contract holders never actually demanded physical delivery. They rolled positions, they settled in cash, they treated silver and gold futures the way most people treat airline miles, as a unit of account, not as something they intended to physically collect. The entire system was built on a single foundational assumption: that delivery demand would always remain manageable. That assumption is now being stress-tested in real time. Track what has been happening on the COMEX floor over recent trading sessions with precision. Institutional players, not retail speculators, not momentum traders, not the kind of participants who reverse positions at the first sign of volatility, have been submitting delivery notices consistently, session after session, pulling physical silver bars out of registered COMEX vaults and transferring them into private, non-reportable storage. The registered inventory, the metal that is formally available to back outstanding paper contracts, has been moving in one direction, down, and the paper contract side of the equation has not shrunk proportionally to match it. What that means in structural terms is that the ratio of paper obligations to physical backing, already stretched by historical standards, is being pulled even tighter. Every bar that leaves a registered vault and enters a private facility widens the gap between what is promised on paper and what actually exists to fulfill those promises. Now, apply a historical lens to understand precisely how significant this is. In the lead-up to the Hunt Brothers silver episode of 1980, a similar dynamic of physical tightness against paper obligations created a price dislocation so severe that the COMEX was forced to change its own rules mid-crisis, limiting new purchase contracts and effectively closing the market to buyers in order to prevent a full delivery default. Read that again, slowly. The exchange changed the rules during the game to protect itself from the consequences of its own structural design. In 2011, when silver ran from $18 to nearly $50 in under 8 months, the trigger was not a fundamental shift in industrial demand. It was the collision of rising delivery requests against a paper market that had been pricing metal as though physical scarcity was an abstract concept rather than an operational reality. Both episodes shared a common architecture with what is being observed today. The difference is the scale of the institutional coordination now driving the extraction and the geopolitical context surrounding it. Here is the layer that transforms this from a market technical into a systemic warning. The entities pulling physical silver off the COMEX are not doing so because they expect to use it industrially in the near term. Silver has genuine industrial applications: solar panels, semiconductors, medical devices, and industrial demand is real and growing. But the speed and consistency of this extraction pattern goes beyond procurement planning. This is strategic positioning. These are entities that have looked at the same East-West premium data examined in Part 1. They have read the same geopolitical architecture that China has been constructing with gold, covered in Part 2. And they have arrived at a conclusion that their delivery behavior is now broadcasting clearly to anyone trained to receive the signal. They do not want exposure to paper promises in a world where physical metal is migrating east. They want the metal itself, in their own vaults, under their own control. And this is where the Sprott discount becomes not just relevant, but critical. Western retail, sitting at a 5.7% discount, while institutions extract physical at this velocity, creates a specific kind of market condition that has only appeared a handful of times across modern commodity history. It is the condition that precedes a repricing event. Not a gradual adjustment, not a slow drift upward that gives everyone comfortable time to position. A repricing event, the kind where the gap between paper price and physical reality closes rapidly and without warning, because the structural pressure that built quietly over months releases in a compression of days. The COMEX has absorbed pressure before. It has changed its own rules before. But it has never faced this specific combination simultaneously. Eastern physical premium widening daily, institutional extraction accelerating, geopolitical architecture actively incentivizing the migration of real metal away from Western paper systems, and a retail base so disengaged that there is no speculative froth to blame when the move finally becomes impossible to contain. The paper market has been writing checks that the vault inventory is becoming less and less equipped to honor, and somewhere in the gap between what is promised and what physically exists to deliver is the precise location of the next major market dislocation. The COMEX is not broken, not yet, but the pressure building inside its structure right now is not the kind that resolves quietly. In Part 4, We move from diagnosis to strategy, because understanding the fracture is only half the equation. The other half is knowing exactly how the smart money is positioning itself before the rest of the world realizes what has already been set in motion. There's a category of financial decision maker that does not appear on television. They do not publish newsletters. They do not post charts on social media. They do not signal their moves through the kind of visible, noisy behavior that retail markets are trained to watch for. They move quietly. They position early. And by the time the broader market understands what they were doing, the trade is already fully loaded. Right now, in the precise intersection of everything covered in the previous 3 parts, the East-West premium divergence, China's gold architecture, and the COMEX structural fracture, that category of player is making decisions that will define portfolio outcomes for the next several years. Understanding the logic of those decisions is not optional for serious capital allocators. It is the entire assignment. Begin with the most fundamental shift in institutional behavior that the current data is revealing. For the better part of 2 decades, sophisticated institutional exposure to precious metals was primarily achieved through paper instruments, ETFs, futures contracts, options positions, mining equity derivatives. These instruments offered liquidity, ease of management, and the kind of clean accounting treatment that large fund structures prefer. That preference is changing. The same entities that previously found paper exposure entirely acceptable are now demonstrating, through their COMEX delivery behavior, through their vault transfer patterns, through the migration of metal into private non-reportable storage, that their confidence in paper settlement has quietly eroded. This is not a panic reaction. Panic looks chaotic and sudden. What is being observed here is measured, deliberate, and executed with the kind of patience that only comes from genuine conviction in a multi-year thesis. The thesis is straightforward. In a world where physical metal is migrating away from Western paper systems at institutional scale, the paper price and the physical price will eventually diverge. And when they do, only one of those prices will matter. Now examine the specific mechanics of how this positioning is being constructed. The first layer is direct physical accumulation, taking delivery from exchanges, purchasing through private refiners, building vault positions in jurisdictions outside the immediate reach of potential asset freeze mechanisms. Switzerland, Singapore, Dubai. The geography of private gold and silver storage has been quietly shifting toward neutral jurisdictions for precisely the same reasons China has been building its own monetary architecture. Sovereignty over physical metal requires physical possession in a stable location. The second layer is mining equity exposure, but not the broad, undifferentiated kind. The smart money is not buying silver mining ETFs. It is identifying specific producers with low all-in sustaining costs, strong jurisdiction profiles, and reserve bases that become exponentially more valuable as the physical price separates from the paper price. When silver reprices, a miner producing at $18 per ounce all-in cost with silver at $120 is not generating proportionally more revenue. It is generating geometrically more profit. That leverage is what institutional positioning in the mining space is quietly capturing right now. The third layer, and this is where the premium mechanics from part 1 become a direct return multiplier, is physical trust exposure at current discount levels. The Sprott Physical Silver Trust, sitting at a 5.7% discount, is not just a data point about retail disengagement. It is a structural entry opportunity for anyone who understands what happens to that discount when Western retail sentiment eventually rotates back toward silver. The move from discount to premium does not happen gradually across years. It happens in weeks, sometimes days, when the inflection point arrives. And the return that movement generates exists entirely outside the physical price move itself. It is a separate, compounding layer of return that most retail participants will never understand they missed until the window has already closed. Now place the gold-silver ratio into this framework as a precision timing instrument. Historically, the gold-silver ratio, which measures how many ounces of silver it takes to purchase 1 ounce of gold, has oscillated between extremes that reliably signal relative value dislocations. At the peak of past silver undervaluation periods, the ratio has touched 80, 90, even above 100 before mean reverting sharply as silver outperforms gold in the subsequent repricing cycle. The current ratio sits at levels that, by every historical precedent available, place silver in the deeply undervalued range relative to gold. This is not a prediction. Predictions require certainty about timing, and serious analysts do not manufacture timing certainty where it does not exist. This is a probability statement, one grounded in decades of ratio behavior across multiple monetary cycles. When gold moves in a sustained direction driven by central bank accumulation and geopolitical monetary restructuring, silver historically follows, and then overshoots, not because silver is gold, but because silver carries the dual identity of monetary metal and industrial commodity simultaneously. When both functions reprice together, the move compresses into a shorter time frame and registers at a larger magnitude than gold's move alone. Here is what the convergence of all four signals means for anyone making serious capital allocation decisions right now. The east-west premium divergence tells you where physical demand is concentrated. China's gold architecture tells you how long this strategy has been in motion, and therefore how much institutional conviction sits behind it. The COMEX pressure point tells you where the structural vulnerability in the Western paper system is located and what happens when that vulnerability is stress-tested beyond its tolerance threshold. And the smart money positioning tells you that the entities with the most sophisticated information access have already drawn their conclusions and are acting on them quietly, consistently, and without waiting for mainstream confirmation. The mainstream confirmation will come. It always does. But it arrives after the positioning window has closed, after the discount has become a premium, after the ratio has begun its mean reversion, after the COMEX pressure has expressed itself in a price move that makes the previous numbers look like a warm-up. The serious question, the one that separates the decision makers in this audience from the observers, is not whether this structural shift is real. The data has already answered that. The serious question is much simpler. When the paper finally has to answer to the physical, which side of that equation are you on? Because the smart money already knows its answer. It has known for months, and it has been moving metal into vaults, one quiet delivery at a time, while everyone else was watching the paper price. The final part, the strategic synthesis, is next, where every signal, every data point, and every pattern covered across this entire analysis converges into a single unified economic warning that serious decision makers cannot afford to misread.